Hello everybody, welcome back to the channel. Today we're going to discuss something that might surprise you. Mobile home park investing. Now, I know what you're thinking, trailer parks? But stick with me, as this isn't what you remember from movies. Over the last decades, it has been a stealthy evolution from a mom-and-pop niche business to a multi-billion-dollar institutional asset class now dominated by big private equity shops and institutional investors. In this video, we're going to tell you precisely why that's happened, the unique business model that allows it to be so profitable, and the real risks you need to know. Let's get started. So the complete foundation of this whole thing, the secret sauce, is this thing called the land-lease business model. This is what makes it completely different from, say, investing in an apartment building. With a traditional apartment, you, the landlord, own the building and the land, and you're renting out the whole shebang. However, in an MHC, or manufactured housing community, the opposite is true. The resident actually does own the physical manufactured home, the building itself. However, you, the investor, own the land on which the home is situated, and you lease the lot to them. This is brilliant. Your investment is focused purely on the land and the contractual right to charge that lot rent. This creates an extremely predictable low-risk cash flow. But here's the kicker. It is extremely difficult, in most locations impossible, to get permits to build a new park. So the supply of these communities is effectively fixed, which gives the existing parks a tremendous competitive advantage. They're not making any more land, and they're definitely not making any more mobile home parks. So why would you want to invest in this? 2 words: stability and resilience. First, put yourself in the resident's shoes. If they get upset about a rent increase, what are their options? Moving a manufactured home is not the same as packing up a U-Haul. It's tens of thousands of dollars, $5,000, $10,000, or more. That's a very high cost of exit. So in a recession or during an economic downturn, people don't move. Occupancies are rock solid. Number 2, there is tremendous, and I mean tremendous, demand for affordable housing in this country. MHCs provide essential housing for seniors and for low to moderate income families that are priced out of the traditional housing market. And thirdly, your risk is diversified. If you have one tenant who doesn't pay or you have to evict, it's one lot out of 100 or 50. It doesn't sink the whole ship. Your risk is diversified over many individual units. Now, this is no longer a secret. The large players have caught on. We've witnessed a massive transition over the past 2 decades. This industry was once the realm of small, local mom-and-pop owners. But today, private equity companies, hedge funds, and large corporations are snapping up these parks in a big way. Just consider the figures. For 2020 and 2021, institutional purchasers were responsible for 23% of all MHC acquisitions. That is up from just 13% a few years ago. We've identified 23 separate private equity firms that now have an ownership stake in over 1,800 parks across the U.S., with ownership of over 377,000 separate sites. This level of institutional interest is a huge vote of confidence in the profitability here. Yet, it also raised the cost of acquisitions, and it's created a much more standardized, aggressive way of operating. So what is the underlying value to an investor? It all traces back to that land-lease model we've been talking about. The single best benefit is that it shifts the maintenance liability from you to the resident. They do own the house, after all, so they're responsible for fixing the roof, the plumbing, the siding, all of it. You're only responsible for the common areas and the infrastructure of the land. That means your operating expenses and your big capital costs are a lot more predictable and a lot lower. You don't need to sweat an unexpected $15,000 roof replacement on a property that you own. But, and this is a big but, this model has created some fierce public controversy. Because the residents are essentially captive, some institutional owners have been aggressively raising rents to boost their profits, and that's attracting the attention of lawmakers and creating new regulatory risks that we have to be aware of. So let's talk about the business's engine, lot rent. This is what you get from the resident for leasing the land. It usually encompasses access to utilities, maintenance of common areas, and possibly amenities. This lot rent is the very lifeblood of the investment. It's what drives your net operating income, or not. And here is the magic of it. Any increase you can gain on that lot rent goes directly to your bottom line and has a multiplied effect on the overall value of the property. Appraisers look at this predictable, low-risk stream of cash flow to determine what the park is worth. So by increasing the rent, you're not just making a little more money on a monthly basis, you're actually making the appreciation of the asset overall, creating profit for investors by having a higher valuation. So how do you actually determine what a park is worth? There's a quick and dirty method to screen deals. You multiply the number of lots occupied by the average rent per lot, and then multiply that by a factor, typically something in the area of 70, which equates to a rough 6% capitalization rate. So, for instance, 50 lots times $300 rent times 70 would get you an approximate value of $1,050,000. Now, that's just for a quick look. A full, detailed valuation is much more extensive. You've got to look at the local market, the demographics, the competition, and you've got to do full due diligence. That means you've got to get your hands on the actual bank statements, utility bills, signed leases, and the rent roll to ensure that everything the seller is telling you is correct. You can't skip that step. If you're going to get serious about it, particularly with development or big value-add deals, you're going to go into advanced financial modeling. You create a model that forecasts cash flows from the very start, through construction until the time that the park is stabilized and ultimately sold. This model will calculate all the key numbers that investors care about: your internal rate of return, your net present value, your equity multiple, and your cash-on-cash returns. It even includes something called a cash flow waterfall, which is just a fancy term for the rule book that governs who gets paid when, how distributions are split between the general partners who work the deal and the limited partners who contribute the capital. One very critical distinction that trips people up: there are two ways to think about your net operating income. There's your operational NOI, which includes all the income you have, including rent from any homes that the park itself owns and rents. Then there's the appraisal NOI, and that's the one that really matters when you're trying to get a loan or sell the house. Appraisers, and more importantly, the Fannie Mae type institutions that issue the loans, will ignore completely the rental income from renting homes. They'll only look at the predictable, long-term lot rent from the land lease. So your number one goal as an investor is always to maximize that lot rent-driven NOI, since that's where you achieve the highest valuation. That gets us right into the two main operational models. You have TOH, which stands for tenant-owned homes, and POH, which stands for park-owned homes. They're completely different. With TOH, your revenue is just the steady, reliable lot rent. Your initial capital is lower because you're just buying the land. Your operating commitment is minimal, just the common areas, and lenders adore this arrangement. With POH, you've got higher gross revenue because you're getting both home rent and lot rent. Your upfront capital, on the other hand, is much higher because you're buying the homes. Your ongoing obligation is a nightmare. You're now the landlord of the homes and are obligated to do maintenance and repairs, and lenders look at this model much more negatively. The risk profile is just much higher. So it is no wonder, I suppose, that the TOH model is the institutional darling. It minimizes your role as owner and lets you focus on that nice, predictable lot rent revenue. It means less management overhead, which makes your financial projections sound and reliable. And most valuable of all, it removes your operational risk significantly. All of that risk of maintaining the homes is transferred entirely to the resident. That's why lendos and appraisers view the TOH model so favorably. It's the simplest, cleanest way to capture the land lease business value. So what if you discover a park that's entirely rentals, all POHs? That's really a tremendous value add opportunity via a strategy named conversion. Picture a 20-lot park where you possess all 20 homes and rent them out. An agency lender will just consider the lot rent revenue for their valuation, disregarding all that additional home rental revenue. So the procedure is, you systematically sell those homes to the tenants. You could pay for it for them. You make them homeowners. Once you've done that, You've essentially removed your future capital expense requirement and your management headaches. You are cleansing your NOI, making it purely land-lease oriented. And once you've accomplished that, the quality of your revenue is so much higher that you get a significantly higher valuation multiple when you refinance or sell the park. To really scale in this business, you need to have the right financing, and the gold standard is agency debt from Fannie Mae and Freddie Mac. They offer incredible terms, but they're institutional scale deal oriented. We're talking about a minimum loan size of $3 million, which immediately takes out the small parks. They'll loan you up to 80% of the value to buy a property, but they have strict requirements. Your debt service coverage ratio, i.e., your income relative to your debt payments, has to be at least 1.25 times, and the park has to be at least 90% occupied, with no more than 5% of the homes being park-owned rentals. The loans are typically for 30 years, and most importantly, they are non-recourse. Wait on that for a second, because non-recourse is such an important term. What it implies is that if the investment goes south because the market declines, the only recourse the lender has is to take back the property. They can't come after your personal assets, your house, your personal savings, to compensate for the loss. This is the shield that allows you to conduct institutional-level investing without insane personal risk. There are exceptions. They're called bad boy carve-outs. You commit fraud, you commingle the park's funds, you go bankrupt, you can trigger full personal liability. So it makes you run the business with integrity and proper financial reporting. You can't, I repeat, can't buy a park without insane due diligence. This is way more than numbers looking. On the legal side, you need a zoning verification letter to make sure the park is a conforming use. You'll need to search for building permits and certificates of occupancy for clubhouses or other improvements. Financially, you need to review the rent roll, all leases signed, and how utilities are charged. And finally, you need to inspect the infrastructure. You need water well tests and sewer or septic records of maintenance. This is where you find hidden multi-million-dollar risks. Aging infrastructure is the sleeping giant of risk in this business. Some American cities are facing billions of dollars in cost to replace rotting water and sewer systems, and it's the same inside these parks. The good news is, you can control this. A strategic, preventative maintenance program is like an insurance policy. It can add 40 to 60% to the life of your infrastructure. It can reduce your overall lifetime costs by 25 to 35%, and it can reduce emergency repairs by over 50%. You need to budget this capital expenditure. It's not a discretionary spend. It's a requirement to guard against a catastrophic system failure that would ruin your cash flow. All right, so let's talk about the greatest risk to our MHC investors today. It is not the market, not interest rates, it is regulation. And this risk is one that was wrought by the institutional investment strategy itself. Here's the problem. Residents are exposed. They're homeowners, but can't afford to move it, so they're hostages to rent increases. Institutional owners trying to maximize returns have come in and implemented aggressive rent normalization, a corporate euphemism for high, sometimes draconian, rent increases. And this, of course, has spawned a political and legislative response. We're seeing it happen in real time in states like Oregon and Washington. In Washington, we're seeing lot rent go up from $610 a month to $1,300. In Oregon, a park went up from $850 to $1,200 in 3 years. Legislators have reacted with bills to rein in the increases. Washington's House Bill 1217 proposed capping all rent hikes on housing at 7% a year. Oregon's House Bill 3054 attempted to tie increases to the Consumer Price Index. There's a nasty ripple effect. When lot rents soar, the value of the manufactured home itself tends to plummet, since who wants to buy a home with a $1,300 a month land lease? How do you, as a smart investor, deal with it? You need to bake it into your plans from the very beginning. This requires conservative underwriting. If you're looking at a park in a highly politicized state, you need to stress test your financial model based on a low CPI-based rent growth assumption, not an aggressive 10% year-over-year plan. If the profitability of your entire investment depends on whether you can increase rents substantially. Your investment is risky. You also need to beware of community organization, where the residents band together to buy the park themselves, and of local ordinances that will give them the first right of refusal to buy. Finally, last but not least, let's talk about the endgame, how you actually make money and get out. The playbook generally is as follows. First, you normalize the operations of the park. You drive occupancy above 90%, and you execute on that rent normalization strategy to force the appreciation of the asset. Then, 3 to 5 years down the road, you do a strategic refinance. Because the NOI is now higher, the value of the property is higher. You go to a lender, and you refinance the loan at, say, 75% of the new higher value. This allows you to pull out your original investor's capital, typically all of it, and return it to them. This sends your cash-on-cash return into orbit. Then you execute an institutional sale. You sell that now stabilized, clean asset to a private equity fund or a REIT who desires that predictable agency financeable NOI. Your long-term success truly hinges on that delicate balance of adding value through operations and not provoking a regulatory nightmare. If you like this video and wish to proceed with your real estate learning, then subscribe to the channel and hit the bell so that you can know what's in store next. To keep your momentum rolling, I've chosen another video for you that will help you in your investing journey. You'll see it right here on the screen. Just click it and go ahead and learn some more. Thanks for watching. I'll see you in the next one.